What if I told you there was a formula, one, that the world's most successful investors use to grow their wealth, protect their future, and create absolute financial freedom, a formula so powerful it could change your life forever? Most people think investing is complicated, that it's a game only the rich can win. That's a LIE. The real problem isn't the market, it's the mindset. The greatest investors in history didn't start with millions. They started with a decision to master the game, not just play it. And today, you're going to learn how to do the same. Most people think of investing as a game of luck, where success depends on timing the market or stumbling upon the next big stock, but that's not how the wealthiest investors approach it. They don't play the game, they master it. They don't react emotionally to the ups and downs. They operate from a place of strategy, discipline, and control. The difference between those who win and those who struggle isn't intelligence or even opportunity. It's mindset and execution. The first step to mastering the game is understanding that the financial markets are structured to benefit those who know how to navigate them. The system is designed to reward those who think long-term, manage risk effectively, and make calculated moves rather than emotional decisions. The average investor tends to chase trends, panic during downturns, and make impulsive moves based on fear or greed. Meanwhile, the masters of investing have a clear plan, stick to fundamental principles, and never let emotions dictate their actions. One of the biggest misconceptions is that you need to take massive risks to see massive rewards. That's a lie. The greatest investors in history, people like Warren Buffett and Ray Dalio, don't gamble. They don't bet their entire fortune on one move. Instead, they look for asymmetric risk-reward opportunities, where the downside is limited, but the upside is exponential. They know that real wealth isn't built through reckless speculation. It's built through smart, consistent, and strategic investing over time. Another critical element of mastering the game is understanding the power of compounding. Too many people believe they need huge sums of money to start investing, but the truth is time is your greatest asset. Small, consistent investments made early can turn into massive wealth over decades. The sooner you start, the less you have to invest to achieve financial freedom. But those who play the game often procrastinate, waiting for the perfect time to start, while those who master it take action now, knowing that consistency beats timing every time. Diversification is another key strategy that separates masters from players. The average investor puts all their eggs in one basket. Maybe they go all in on tech stocks, cryptocurrency, or real estate. When the market turns against them, they lose everything. But those who master the game understand the importance of asset allocation. They spread their investments across different asset classes, stocks, bonds, real estate, commodities, ensuring that no single downturn can wipe them out. This way, they're always positioned to win no matter what the market does. The final piece of mastering the game is developing an unshakable mindset. Market crashes, recessions, and economic uncertainty are inevitable. The average investor panics, sells at the worst time, and locks in their losses. The master, on the other hand, sees downturns as opportunities. They know that bear markets are when the greatest fortunes are made. They don't react, they anticipate. They don't fear volatility, they embrace it. Financial success isn't about luck or intelligence. It's about mastery. It's about understanding the rules, developing a winning strategy, and executing with unwavering discipline. Those who play the game will always be at the mercy of the market, but those who master it, they create their own financial destiny. Wealth isn't just about numbers in a bank account, it's about mindset. The truth is, financial success starts long before the first dollar is invested. It begins in the mind. The way you think about money, risk, opportunity, and abundance determines the results you create. Most people believe they need millions to feel secure, but the reality is, without the right mindset, even the wealthiest individuals can live in fear of losing it all. Meanwhile, those with the right psychology can start with nothing and build unstoppable momentum toward financial freedom. One of the biggest differences between those who accumulate wealth and those who struggle is their relationship with money. Most people operate from a scarcity mindset, constantly worrying that there's never enough. They fear losing what little they have, so they hold back, avoid risk, and stay trapped in the cycle of financial limitation. This fear-based mentality prevents them from making strategic moves. taking calculated risks and seizing opportunities when they arise. On the other hand, those who achieve real wealth understand that money is a tool, not a master. They operate from a mindset of abundance, knowing that financial success isn't a matter of luck, it's a matter of strategy, discipline, and belief. Successful investors and entrepreneurs don't just focus on making money, they focus on growing, learning, and developing themselves. They recognize that wealth isn't something you chase, it's something you attract by becoming the kind of person who can create and sustain it. They develop resilience, the ability to adapt, and the courage to take action even when uncertainty is high. They don't let fear control them because they know that every major financial breakthrough happens on the other side of uncertainty. Another key factor that separates the wealthy from the struggling is their willingness to think long-term. Most people want instant results. They chase quick wins, get discouraged when they don't see immediate success, and give up too soon. But those who build lasting wealth understand that financial success is a marathon, not a sprint. They commit to a long-term vision, making decisions today that will pay off years or even decades down the road. They embrace patience, knowing that consistency and discipline will always outperform short-term thinking. The wealthy also have a different relationship with failure. Most people see failure as a sign to stop, a confirmation of their worst fears. They take a financial loss or a setback as proof that they aren't meant to succeed. But those with a millionaire mindset see failure as feedback. They analyze their mistakes, adjust their strategies, and come back stronger. They know that every setback is just a setup for a greater comeback. Financial success isn't about the money itself, it's about the person you become in the process. The right mindset creates confidence, resilience, and the ability to turn any situation into an opportunity. Without it, even millions can slip through your fingers. But with it, wealth becomes not just a possibility, but an inevitability. Most people believe that making money requires taking big risks, but the most successful investors don't gamble, they play smart. They understand the power of asymmetry, the principle that allows them to risk a little but gain a lot. Asymmetric investing is the secret weapon of the wealthiest individuals. It's not about betting everything on a single opportunity, it's about making calculated moves where the potential upside far outweighs the downside. This is how fortunes are built, not by luck, but by strategy. The average person approaches money with a linear mindset. They think in terms of work more, earn more, or invest more, gain more. But the real winners in the financial game know that wealth isn't about working harder, it's about working smarter. They don't look for investments where they have to risk everything for an average return. Instead, they look for opportunities where they can risk $1 and have the potential to make 5, 10, or even 100 in return. They understand that success isn't about playing it safe or taking reckless risks. It's about identifying opportunities where the odds are stacked in their favor. One of the biggest examples of asymmetry in investing is venture capital. The most successful investors in the world don't expect every investment to succeed. They know that out of 10 investments, 6 or 7 might fail, 2 or 3 might break even, but one could be 100 or even 1,000 times more valuable than the rest. That one success more than makes up for the losses. This is how tech moguls and startup investors build massive wealth. They aren't afraid of small losses because they know their wins will far exceed them. But asymmetry isn't just for venture capitalists. It applies to the stock market, real estate, and even personal growth. The greatest investors don't put all their money into one stock or one property. They strategically diversify, always looking for situations where the upside is far greater than the downside. In the stock market, this could mean investing in industries poised for massive disruption. In real estate, it could mean buying undervalued properties in areas set for growth. The key is finding opportunities where the potential reward is so high that even a small risk is worth taking. Asymmetry isn't just about financial investments, it's a mindset. It's about looking for opportunities in life where small, smart moves can lead to massive payoffs. Learning a high-value skill, networking with influential people, or taking a calculated career risk can create opportunities that far outweigh the initial effort. The most successful people don't just think in terms of money, they think in terms of leverage. They ask, how can I put in a little effort now to create exponential results later? When you adopt the power of asymmetry, you stop playing small. You start looking for opportunities that can transform your life with minimal downside. The wealthy don't think in terms of playing it safe. They think in terms of maximizing potential. And when you understand this principle, you start seeing wealth-building opportunities everywhere. Compounding is the silent force behind almost every great fortune. It's been called the eighth wonder of the world, and for good reason. When you understand how it works, you realize that wealth isn't built overnight, but over time through the power of exponential growth. Most people underestimate the impact of compounding because in the beginning, the results seem small, but given enough time, even modest investments can turn into massive sums. The key is to start early, stay consistent, and allow time to do the heavy lifting. The biggest mistake people make is thinking they need to wait until they have a lot of money before they start investing. That's the exact opposite of how compounding works. The sooner you start, the more time your money has to grow, and time is the most powerful ingredient in this formula. Imagine two people. One starts investing $300 a month at age 25 and stops at 35, never adding another dime. The other starts at 35 and invests the same amount every month until retirement. Even though the second person invests for decades longer, the first person ends up with more money. Why? Because the early years matter most. The money that compounds over a longer period has the biggest impact. Compounding isn't just about money. It's about discipline and patience. The reason most people never fully benefit from it is because they interrupt the process. They withdraw money too soon, chase quick profits, or get scared during market downturns. But those who master compounding understand that the biggest returns come to those who leave their investments alone. The most successful investors aren't the ones constantly buying and selling. They're the ones who let their money sit and grow uninterrupted. One of the most powerful examples of compounding is Warren Buffett. He started investing at a young age, and while he made smart investment choices, the real secret to his wealth isn't just his stock-picking ability, it's time. Over 90% of his wealth came after his 60s, not because he suddenly got better at investing, but because the force of compounding had enough time to work its magic. If he had started later or withdrawn his money along the way, his fortune would look drastically different. Compounding isn't just for investors. It applies to every area of life. Skills, knowledge, and habits compound the same way money does. Small, consistent efforts add up over time, leading to exponential results. A person who reads 10 pages a day may not seem to be making massive progress, but over years they gain knowledge that transforms their thinking and opportunities. Health and fitness work the same way. Small daily habits create long-term transformation. The biggest takeaway is that compounding rewards those who think long-term. The earlier you start, the greater your advantage. The more consistent you are, the bigger the results. And the more patient you become, the more you realize that wealth, success, and mastery are not the result of one giant leap, but of small actions repeated over time until they become unstoppable. When it comes to building lasting wealth, most people focus on picking the right investments, chasing the highest returns, or trying to time the market. But the truth is, none of that matters as much as asset allocation. It is the foundation of any successful investment strategy. The single most important factor in determining long-term financial success. The wealthiest investors don't just pick good stocks or find great opportunities. They strategically spread their investments across different asset classes to ensure they win in every market condition. The mistake most people make is putting all their money in one place. They might go all in on stocks when the market is booming, or they may dump everything into real estate because it seems like a safe bet. But every asset class goes through cycles. What works today might not work tomorrow. The key to long-term success is diversification, not just within an asset class, but across multiple asset types. The goal isn't just to maximize returns, it's to protect against risk, ensuring that no single downturn can wipe out everything. A properly allocated portfolio includes a mix of stocks, bonds, real estate, commodities, and even alternative investments like private equity or cryptocurrencies. Each of these plays a different role. Stocks provide growth over time, but they come with volatility. Bonds offer stability and income, smoothing out market swings. Real estate provides passive income and serves as a hedge against inflation. Commodities like gold and silver protect against currency fluctuations and economic downturns. The right mix of these assets creates a portfolio that can thrive in any environment. One of the biggest lessons in asset allocation comes from the most successful hedge funds and institutional investors. They don't try to predict the future. They prepare for every possible outcome. A classic example is Ray Dalio's all-weather portfolio, designed to perform well whether the economy is growing, shrinking, inflating, or deflating. It's structured so that no matter what happens in the market, some part of the portfolio is always working in your favor. This is the level of strategic thinking that separates those who build generational wealth from those who merely ride market waves. Beyond diversification, asset allocation must be dynamic. The economy changes, personal financial goals shift, and market conditions evolve. Successful investors don't just set their allocations once and forget them. They rebalance regularly, adjusting their mix based on what's happening in the world and their own financial situation. This doesn't mean constantly buying and selling. It means making smart, strategic adjustments over time to maintain the right balance of growth, stability, and risk protection. The ultimate goal of asset allocation is financial freedom. It's about having a plan that ensures security regardless of what happens in the markets. When done correctly, it allows money to grow without taking unnecessary risks, provides stability during economic downturns, and creates a financial foundation that lasts a lifetime. The key is to stop chasing returns and start building a portfolio designed to win in any market. Because in the end, it's not about how much you make in the short term, but how much you keep and grow over time. Financial freedom isn't just about having money. It's about having control. It's the ability to live life on your terms without being bound by financial stress, limitations, or the need to trade time for money. True financial freedom means waking up every day and choosing what to do, where to go, and how to spend your time because your money is working for you instead of the other way around. It's not about being rich. It's about most people believe that financial freedom is something only available to the ultra wealthy, but that's a myth. It's not about luck, inheritance, or making millions overnight. It's about building a strategy that allows money to flow in whether you work or not. The key is creating multiple streams of income, leveraging the power of investing and making money work harder than you do. The difference between those who struggle financially and those who reach financial freedom isn't intelligence or background. It's the way they manage, grow, and use their money. The first step toward financial freedom is mastering your cash flow. Most people live paycheck to paycheck, no matter how much they earn, because they let expenses rise with their income. But true financial freedom comes from understanding the difference between active income and passive income. Active income requires constant effort. You work, you get paid. Passive income, on the other hand, keeps coming in whether you work or not. Those who achieve financial freedom prioritize passive income streams like investments, rental properties, dividends, and businesses that don't require daily involvement. Investing is the real key to escaping the rat race. The wealthiest people don't just save their money, they put it to work. They understand that money sitting in a bank loses value over time due to inflation, while money invested wisely multiplies. Whether it's in the stock market, real estate, or other asset classes, investing allows money to compound, creating exponential growth over time. The earlier you start, the easier the journey becomes. Beyond investing, financial freedom is about minimizing financial stress. Debt can be a massive obstacle, keeping people trapped in a cycle of endless payments. While some debt, like mortgages or business loans, can be strategic, consumer debt, credit cards, car loans, and unnecessary spending keeps people stuck. Those who reach financial freedom learn to eliminate bad debt quickly, freeing up more money to invest and grow their wealth. Another crucial element is designing a life where expenses are lower than passive income. It's not about extreme frugality, but about making conscious financial decisions. People often chase more money thinking that's the solution, but financial freedom isn't about how much you earn, it's about how much you keep and how effectively you deploy it. Those who reach this level of control know that time is their most valuable asset, and financial freedom is ultimately about reclaiming it. At its core, financial freedom isn't a number, it's a mindset and a strategy. It's about making money work for you, eliminating financial stress, and creating a life where you call the shots. The sooner you take control of your money, the sooner you take control of your life.